Well, good afternoon and welcome everybody to our International Small Cap Investing webinar, Can't Make Diamonds Without Pressure. My name is Chris Labounty. I'm the advisor consultant for the Northeast here at Manning & Napier. And with me today, I have Henrik Strabo, Chief Investment Officer and Portfolio Manager at Rainier. Henrik has been with Rainier since 2011 and brings more than 30 years of experience, including International Chief Investment Officer positions at American Century and Clay Finley. And then I'm also joined by Jeffrey Ingraham, Managing Director of the Portfolio Strategies Group at Manning & Napier. Jeff and his group work closely with our research department and are responsible for conveying the firm's views on the economy, capital markets, and portfolio management to clients, as well as communicating the firm's investment process and portfolio positioning across multiple sales channels. And with that, I'm going to just run through our agenda very quickly here. So first, we're going to have Jeff give us a brief discussion on the asset class more broadly. And then I'm going to turn it over to Henrik to discuss some compelling opportunities he sees in today's market, followed by a discussion of some key macroeconomic conditions impacting investors in the international small cap space. We'll round out that discussion with Jeff talking about a few use cases for the international small cap within client portfolios. And then lastly, we're going to leave some time at the end for Q&A from the field. We do have some pre-submitted questions, but feel free to continue to submit additional questions through the chat. And at the end, we'll do our best to get through all of those. And now I'm going to turn it over to Jeff to kick off our agenda today.
Yeah, thanks, Chris, and welcome everyone. I thought where I would start is just based on the past couple years and the many hundreds of conversations and interactions we've had. Really what we found is there's a pretty wide gap in terms of the utilization of international small cap as an asset class in advisor and client portfolios. And I think on the one hand, you have heavy users, and I'll sort of define a heavy user as someone that is allocating to the asset class explicitly, and in many cases, maybe allocating more to this asset class than any other international equity asset class. And then you have others that maybe aren't allocating at all. So sort of to bridge that gap a little bit, I thought I'd provide a little bit of background on what we mean when we talk about international small cap companies and the asset class. And so what I'll start with is just kind of the bold statement that really jumps out first here on the page is it's the largest opportunity set in all of the public markets. So it includes over 4,000 companies. And so when you sort of put it in those terms, nearly half of every publicly traded company in the world is classified or would be classified in the international small cap market. And it's kind of the nature of these companies. We're talking companies as small as, a $15 million market cap and as large as, a $7 billion market cap with a median right around $500 million. So not only is it a huge opportunity set in terms of the number of companies that exist in this asset class, it's also vast from a geographic standpoint. So it's covering 23 of the developed market countries, 24 emerging market countries, over 40 different currencies represented in the international small cap benchmark. So it is huge, both in terms of number, but also, I guess, sort of scope and scale and vastness of geographic representation. And then the last point I think is worth mentioning is that dedicated exposure here really is required to get true exposure to the asset class. And so, there's a mutually exclusive sort of definition between the ACWI ex-US or the EFI benchmark and the international small cap benchmark. So if you're utilizing managers that maybe benchmark themselves against the EFI benchmark, the ACWI ex-US, you're typically not getting any exposure whatsoever to international small cap companies, and certainly not in a meaningful or diversified way. So you really have to have dedicated exposure to the asset class to enjoy some of its benefits. And sort of on the topic of benefits, I think anytime you're talking about why should I be investing in this asset class, the common things to look at are going to be what return is available to me and what is the risk that I'm taking. And so kind of along those lines, if you go back to really sort of the start of the modern international equity market, so we're going back to 1999 here. I say the start of the modern just because that's when the data on international markets as a whole is most reliable. But I think there's also relevant sort of economic data points here too. It's around the time or the time of the adoption of the euro. It's also around the time that China joined the WTO and sort of entered the global stage. So really that's the time period that also is probably representative today. And if you look back over this, 20 plus year time period within the international markets and kind of the choices you have of large and medium-sized company with the ACWI ex-US or the international small cap market, you can see smaller companies have outperformed significantly over this time period to the tune of more than 2.5 percentage points annualized. And I think, maybe the immediate reaction is going to be, well, yeah, that's the small cap premium. We would kind of expect that. But the reality is, the idea of a small cap premium is associated with this idea that there's just a lot more risk you're taking on. And I think if you look at the volatility of returns, which is in the middle graphic here, it's really sort of an imperceptible increase in volatility, right? Kind of 17 versus 18. So really with the same volatility historically with international small cap, you've gotten more than 2 percentage points of extra return. So certainly, viewed on those metrics, it's a much more attractive area to look for opportunities in international markets. And maybe just kind of the last comment I'll make is, through our conversations over the years and over the decades, we've found that domestic small cap is often a very common sort of model portfolio allocation in a lot of portfolios. And so I think when folks are thinking about international small cap, there's an immediate association between the two. And I think there's a pretty stark difference in terms of the risk return or the return pattern over time with international small cap companies versus domestic small cap. And that's really sort of borne out on this last graphic on the most right-hand side here. All we're doing here is we're saying, look, when the broad US equity market is up, how much are domestic small cap companies capturing of that upside? And conversely, when the broad US market has a negative return, what is happening in the domestic small cap space? And you can see it's a pretty exaggerated profile historically. When the market's going up, small caps go up by a lot. When the market's going down, small caps go down by even more. And it's an unfavorable kind of up-down capture, right? Where the downside capture is more than the up. It's a very different pattern in international markets, interestingly enough, historically, where, based on these metrics, you've captured all of the upside when the market is going up, but less of the downside when the market's going down. And, there's no sort of provable sort of rational or theory to it, but a lot of it may be just given the number of companies and the true geographic diversification that's offered here. That's maybe one reason I would put forward why this return profile has been different historically than what maybe you have experienced in domestic small cap markets. And then the last comment I'll make, and I'll sort of bring Henrik in at this point, is just the other thing that the large size of the market offers as an attractive opportunity set is just the fact that there's not a lot of sell-side securities analyst coverage of these companies, and certainly not when compared to, let's just say, the US large cap market. And so skilled, experienced, dedicated investment managers are getting direct access to these companies and learning information that is not being widely published to everyone else in the investment community. So there's a real sort of active management opportunity that's available here. And obviously, Henrik, you've been doing this for decades now at this point. When given the opportunity a little over 10 years ago to launch a new strategy, this was where you wanted to be. So maybe with all of that as a background, I'll kind of ask you the question of, how do you approach investing in this market, and how do you figure out who you want to own out of these 4,000 plus companies that are available to you?
Great. Thank you, Jeff. Yeah, as you mentioned, this is a fantastic and a very unique asset class. It's full of incredible companies to invest in for the long term. And that's exactly why I launched this fund more than 10 years ago. And if I had the same opportunity today, I would absolutely do it again, because it is a very unique opportunity in the global investment area. I truly believe that our research-intensive process based on experience and with focus on going after grown-up small caps puts us squarely in the sweet spot of the asset class. We want to invest in the slightly larger companies within the asset class and identify the long-term winners and really try to stay away from the smaller companies that we think are too risky. They tend to have poor market positions and also very often poor governance, which can really come back to haunt you. So we're really looking for where we can be to get a very favorable return risk profile. And so the process really takes us to the what I call grown-up small caps. And the ones that exhibit positive fundamental change. We want to see some very strong underlying positive trends within the business, and with clearly identifiable drivers of growth that we also believe are sustainable. Companies with large and growing addressable markets relative to the size of their own business. We like to invest in companies that where the investment case is very clear and, quite frankly, simple. Established dominant companies, we like to invest in companies that have a very leading position in terms of market share or innovation and dominate what we call their chosen ecosystem, whether that's in the local markets or in the region. And in some cases, we have global winners as well, even though they are small mid caps. So I think one of the reasons that we historically have been able to produce a good return risk profile is that we have stayed very focused on sort of the larger companies that are established within the asset class. And I think the process that we have established, which is very research intensive, particularly focused with speaking with management companies continuously, really dovetails well with going after the grown-up small caps, as we call them.
Yeah, and I know you mentioned sort of governance as a risk. You know, anytime you're investing, certainly some of these smaller companies, maybe it introduces a little bit more risk just because they don't have the same sort of resources and perhaps scrutiny to focus on that. You know, and we've talked a lot about, you know, ESG investing right now, or certainly over the past couple of years, has been the trend. Maybe any sort of comments you would make with regards to your thinking about ESG in your own strategy and also in the asset class itself.
Yeah, ESG, I think, is an important development. It's also a very misunderstood development. I'll state up front that we are not ESG investors, but there are certain areas within ESG that we tend to gravitate towards, and it's really to help identify risks that maybe investors haven't paid enough attention to in the past, but it also really pushes the companies to build their own ESG framework so they can identify risks that the business might face. ESG is evolving. It will continue to evolve. I would say not long ago, maybe defense and energy was more frowned upon. I think people are starting to relax that a bit, particularly given what's currently going on around the world. But that can be transitory. One of the biggies for us is governance. I firmly believe that if you have poor governance, it's like building a house on a very bad foundation. So we spend some time when we speak with management is really trying to understand the structure, the management structure, the incentives, the position of CEO, chair of the board, and also the competence at the board level. I think that is very important. If there's a major shareholder in the firm, particularly when it goes above 50%, sometimes that can be a founder, but it can also be government or other entities. That doesn't necessarily kill the investment case, but we need to understand what the sort of the potential good and bad news could come with that. In terms of the companies that my experience with talking to companies that embrace some of the key attributes of ESG, I would state that they tend to be better run companies. If you are able to run a business more efficiently, lowering the risk in terms of energy or supply chain, the way you operate in the local communities, no bad headlines. That's bad for companies. We see that all too often. There are a lot of good attributes that come out of ESG that I really think that helps management run a better and more efficient and less risky business ultimately long term, which I believe is very good for shareholders. Another area is the sort of the talent wars in terms of attracting talent, and particularly younger people want to work with companies that stay true to sort of a more ESG related type of vision. And we've talked to many companies that believe that if they did not embrace this, it would be more difficult for them to either retain or attract the best talent. So it's something that we are paying attention to, but I will state up front that we are not ESG investors, but there are some key attributes that helps us focus on risks that I think are very important. It helps management create a clear vision for the business and a strategy, which ultimately crystallizes their capital allocation strategy and process, which is absolutely important for the long-term health of a business.
And I see one of the questions that was asked. I'll just maybe address it really, really quickly here to kind of summarize the comments you just made. There's certainly more of a growth bias to the portfolios and the companies we're investing in, but we certainly don't limit the investment universe just by someone else's definition of growth. So we don't just look at the growth index. And I think, a lot of the pre-submitted questions, and I'm sort of anticipating a little bit, the questions that are on people's minds right now as they're listening is all about the risk. But before we go to the risks and the seemingly never-ending negative headlines in today's markets, let's focus a little bit on where we are finding opportunities. Again, just given the nature of the asset class, its size, its geographic reach, I think one of the appeals you've talked about is that there's always these pockets of opportunities that exist. So maybe if you could just touch upon what you're seeing in terms of the most compelling opportunities today.
Yeah, the investment sort of field continues to change all the time, and opportunities will rise and they will sunset over time. And when we have big changes in the global economy, that creates big winners and big losers. One area that we believe has a lot of potential long-term is in the area of renewable energy and sort of the whole digitization and electrification of the global economy. This is pushed not just by government directives. The EU is pushing really, really hard on this. And the more recent US legislation is giving it a big push here in the US as well. But more importantly, a lot of companies are pushing this. So you see companies like Amazon and Google that are moving very rapidly to way lower their CO2 footprint and to supply the energy for data centers in particular through alternative or renewable energy. So we believe that this is a big area for opportunities, both in wind, solar, also in hydro, and of course in batteries. When you have volatile stream of energy as renewable creates, then backup batteries becomes very important. So we have exposure to all these areas in different parts of the world, and I think that this is a good area to invest in. In order to digitize, electrify the global economy, particularly through renewable energy, the development of electric vehicles, we need some mission critical metals to create that. Without those metals, you really can't do it. So we also see some opportunities in areas like copper, lithium, nickel, rare earth that go into to all of these areas. You simply cannot manufacture the batteries, the wind, the solar, the hydro, and a whole other host of electronics without those metals. They also happen to be either difficult to get at or limited in supply. So as anything, as we go through cycles over time, we believe that there's going to be long-term structural demand for these metals, and pricing is probably going to be less volatile than some compared to like iron ore and other metals that are much more readily available. And what also dovetails into this is coming up with sort of a bridge to the future in terms of energy, that is LNG. We're seeing a very significant build out of that. Europe, as we'll talk about later, is under pressure with gas being cut off from Russia, and so we're seeing a very dramatic buildup of LNG infrastructure. That takes time, but we have exposure to that. Also, grids, power grids needs to get upgraded and maintained. We have exposure to that. And then we have consulting companies that consult in all these developments, whether it's oil, gas, LNG, wind, solar, batteries, you name it. So we see this whole area as a pretty significant long-term opportunity.
Yeah, and I think, particularly when you talk about maybe some of the metals, I think thinking about the sourcing of the mining and refining capacity for the whole metal complex has been brought into question, just because some of the biggest players there, Russia and China. And so that introduces this idea of just COVID really, I think in a lot of ways, made businesses rethink their supply chains. And then the Russian invasion of Ukraine has made people think sort of geopolitical partnerships that they've had. And so I think the combination of those two has also introduced another opportunity for investing in the international small cap space. And I say that because I think similar to the renewable energy is you're really able to get kind of pure play exposure to a lot of these more unique areas that can be critical to the overall sort of secular theme that can be a global theme. So maybe just talk a little bit about how you're seeing supply chains being reconfigured over the past couple of years and where the opportunities are.
Yeah, no, as you said, we're seeing a massive disruption in supply chains globally. And one of the problems, I mean, there are several problems, and some of them are transitory. One, I think, big problem was that in the past, companies really pushed the physical limit in terms of their supply chains to make them as efficient as possible, meaning keeping minimum inventory. That makes good financial sense if you're able to pull it off. It also introduces a lot of risks, because if there's any disruption to that chain, then you're suddenly out of luck when it comes to your supplies. And that is a huge risk for the business. So really the first sort of wake-up call for this was COVID, when a lot of economies more or less shut down. A lot of manufacturing came to a standstill. Chip manufacturing also slowed down, which of course had a huge negative impact on many areas, including auto production, which of course has a big impact on GDP in parts of Europe and Japan and also in the US. And it was also further aggravated by the war in Russia with Ukraine, both from an energy standpoint and from fertilizers, auto parts, and quite frankly, also a lot of very important metals that are needed. So this pressure, I think, has highlighted the sort of the importance of starting to rearrange the supply chains, quite frankly, making them less efficient but less risky. And I think that's a good thing. China is still struggling with COVID, and there are a lot of changes taking place in that economy. So some of the supplies there have become more risky longer term than they possibly were in the past. China has also, several years ago, stopped exporting deflation. They have a rapidly aging population, just like we have. So the cost of what they produce are going up. So companies have been looking for alternatives, and so far some of the big beneficiaries have been more reshoring to places like Vietnam, Malaysia, particularly in the chip industry. Also India, I think long term is going to be in a very good position to pick up a lot of what may come out of China. Some of it will come back to North America, US, Canada, Mexico, and it will come back to Europe and also to Eastern Europe. All these areas are more expensive. So we're probably going to live in a more expensive world than we've been used to, but it puts huge focus on automation and efficiency. That means investing in robots and tools that can make up for that cost difference. And we find several opportunities out there as well, where that will benefit long-term from basically a rejigging and reshoring of the supply chains. So in the midst of all the gloom and doom, there are some very, very interesting opportunities to invest in.
And so, Henrik, I know we've talked a little bit on the micro on a couple of themes that you've looked at, but certainly I think this year and maybe even starting before this, I think a major driver of equity markets in general, but especially in the international small cap space, it seems like macro forces have been maybe a bigger driver of returns than individual company fundamentals. So maybe if you could kind of walk through some of these, macro headwinds and your thought process here, and maybe if we're potentially going to get some relief around some of these areas at some point, and what that might have in store for the asset class.
Yeah, no, it's a we have been through a lot in the last three years, and it seems like the newspapers and media is very focused on a lot of gloom and doom, and that is because there has been some recent pain. We have basically been, everything has been thrown at us. We have a war where it's difficult to see how and when that might end. We're still dealing with COVID, and particular places like China that still has very, very significant lockdowns in the population, which hurts economic growth and also production. We have experienced a huge boost of inflation, which has been driven by a number of different factors that we haven't seen for quite some time, but we have seen it in the past. So this is nothing new. We have seen the sharp raise in interest rates in the US, mostly in the US. That has also happened many times in the past, and to a much, much greater extent than what we're experiencing now. We are experiencing food insecurity, which is driven by droughts, flooding, wars, fertilizer shortages. We're also experiencing energy insecurity, driven by a number of different factors, including wars. It is interesting to see, though, that the price of oil is now below where it was when the Russia-Ukraine war broke out. So things don't stay at the same level forever. And we're also starting to see some effects, I think, of more risk introduced by climate change. Probably the biggest sort of pain that we have seen has been the very sharp rise from basically 0% to where US interest rates are today, and the projections are that we're going to be maybe at 4% by the end of the year on the short end. And that, of course, has had an impact on all asset prices, whether it's bonds, stocks, private equity, you name it. But it has also had an impact on the currency. So the US dollar has had, I would say, close to a historical move, but it has happened many times in the past, and also there have been bigger moves in the past. But the move has been significant against the yen and also the euro in particular. The interesting thing is that some of the drivers of this very strong dollar move are not going to be with us forever. The US rates most likely is not going to keep going up at the rate that they're going up now. So the delta, the change in the rate of change, will eventually start to flatten out. You're also starting to see interest rates moving in other parts of the world, in the UK. And this morning we saw a 0.75% increase in the European rates. That was all well anticipated, but there's clearly more coming. So there may be some relief on the dollar at some stage, because the rate of change in US rates, interest rates, will start to flatten eventually, and you're seeing a catch up overseas. So I would say the war, of course, has had some impact on this as well. Typically, when there is something bad happening somewhere, the US is sort of a place that investors flock to in the short term. If you look at these big currency moves, historically, when you see them, they tend to reverse very quickly. Of course, the impossible thing is to predict when that inflection point is, but typically when they go through that inflection point, the reversal can be just as dramatic as a way up or down for the currencies. Another area of sort of concern is China's regulatory crackdown in response to COVID in particular. We are now several years into COVID, and we're still seeing significant lockdowns in some of the major cities in China. So that will continue to put pressure on the supply chain. But as I mentioned earlier, companies are already working very hard to create, I would say, better and stronger and more sustainable supply chains. The war between Russia and Ukraine is a horrible situation, both from a humanitarian standpoint, but also from an economic standpoint. There's a lot of talk about energy shortage, particularly in the winter. I presume some people will be wearing more sweaters and mittens and earmuffs than they have in the past. Gas has been cut off, at least for now. So that most likely will hurt. It is hurting households because the prices of energy have gone up, and ultimately will hurt some companies. Not all companies. Some companies will either be neutral or benefit from it. And the supply chains will continue to aggravate. But as in any time when you see a big change, either positive or negative on the global economy, people and companies have a remarkable ability to adapt. And we're seeing that every day. Companies are making changes to sort of try to reposition them in a better way than they were before. So these are all solvable issues. On top of that, we have politics is definitely getting more interesting globally. It's certainly getting more interesting in the US, in the UK, and in different pockets of Europe, in Italy. A lot of this is driven by some of the past policies where the printing presses have been going 24/7. And typically when you have printing presses going on for as long as they have been going on, it distorts wealth in the economies and will inevitably favor people with large asset bases, meaning people that own real estate or stocks, and they have benefited disproportionately. And the differences between the haves and the have-nots in many countries, including the US, have become extreme. And as history will tell you, that can trigger disruptive politics. So that's something that we are watching very closely, but it's really it's not just Europe or internationally, it's all over the place. So given all this, I believe that we're in a period now, and we'll be going into a period where really good companies that are well positioned, that are dominant in what they do, are able to take advantage of the weaker competitors, really will shine. It's more difficult for them to shine when everything is great and when you have zero cost of financing. That has all changed, and I think that will really help put the spotlight on our investment process, the type of companies that we look at, and the type of companies that we have in the portfolio. So when you see all the headlines out there, yes, they look daunting. A lot of them will disappear over time. If history is any guide, we will move on from this, and there will be other issues. But we will live, I think, in a more challenging environment with less efficient supply chains, meaning probably higher costs for goods and services long term, which puts good companies versus marginal companies in a very, very good position. Thank you.
I think I'll maybe just stay on the slide for 1 minute here, just because I'm seeing kind of the nature of some of the questions that have come in previously and coming in now. And just to maybe address some of those more directly, we have historically never hedged currencies in this portfolio. The benchmark is unhedged. Our portfolio is unhedged. Certainly, we can manage exposure vis-a-vis the companies that we own as one way to think about the currency risk in the portfolio, but we've not hedged currency risk. And the currency's been a major headwind this year. I mean, the dollar, weighted against a basket of currencies is up about 15% year to date. So thinking of it from sort of US based investor terms, those foreign assets that you're owning, when brought back to US dollars, that's hurt you by 15%. So some of that performance we're seeing, and actually if you kind of look at some of the numbers, maybe half of the negative performance this year has just come from the dollar strengthening. And I think, Henrik, you made the point that typically it can move to these extremes, but it's hard. Certainly, I think the ECB today, right, raising rates 75 basis points, they're starting to play a little bit of that catch up from a behind position. So that's probably going to be less of a fuel for dollar strengthening going forward. And the other idea is just that, why do I want to look at this asset class, right? The sort of fear that exists today with recessions in the UK, recessions in Europe, potential recessions in the US, right? All of this talk of recession, I think, you summarized it pretty well there, Henrik, which said, we've faced these types of challenges in the past. The slide we had earlier that shows the performance of this asset class historically took into account the recessions that were hitting in the late 90s, early 2000s, the global financial crisis, the COVID crisis, right? So the markets have a tendency to sort of withstand some of these. And while all of the press tends to be a little bit negative right now, I think certainly you've made the case that there are opportunities that are presenting themselves because of what's happening right now. And sort of on that topic, I think another area where we've seen, investors allocating when they're looking internationally is this appeal of emerging markets. And we acknowledge it and we get it. And the appeal comes from sort of the demographic trends that you hear about in the developed world versus much more attractive demographic trends in the emerging world. But just because those demographic trends are favorable does not necessarily always sort of translate back into returns for investors. So earlier on, we kind of did some comparison of international small cap versus the broad international markets. Here we're narrowing in on emerging markets itself. And you can see, again, just kind of looking historically here, we're doing the last 10 years, but the patterns hold true if you go back to 99, like we were doing earlier, which is to say, you've seen significantly better performance from international small cap companies, and the kind of profile of those returns has been much more attractive, right? So we already covered the up-down capture over the last 20 plus years. You can see it over the last 10 years here, 105% upside, 99% of the downside. You compare that to emerging markets where it has seen only 98% of the upside over the last 10 years, and unfortunately 108% of the downside. So I think if we were going to sort of make a case here, it would be that international investing has been incredibly challenged by what has defined the past, call it 10 plus years, kind of the post-global financial crisis period. And that is ultra low interest rates, China continuing to sort of be part of the global supply chain and deporting deflation, exporting deflation. And I think as you just laid out here, that's no longer the case, right? So we have certainly some macroeconomic forces that are shifting. And then, this has been the asset class to be in, right, within the international equity space. So to continue to sort of have that diversification and have that exposure in an investor's portfolio, we would advocate and argue for, a pretty meaningful allocation to international small cap to get you that diversification potential and also the opportunities that present themselves because of the nature of the asset class and the companies that exist there. So Chris, maybe I'll just kind of have you close things here.
Yep, absolutely, Jeff. So just a quick reminder on the strategy. So Henrik has a 10 plus year track record with the Rainier International Discovery Fund, the International Small Cap Strategy. And he's been doing this for over 30 years, as I mentioned in the introduction, but he also has a dedicated team of experienced people with a couple of decades of experience apiece themselves. And I think Jeff laid out a pretty meaningful case on why this, might be the right time to take a harder look. So that kind of ends our prepared remarks, and we're going to leave the last few minutes for some Q&A. So please feel free to continue to add to the Q&A. I do have a couple of pre-submitted questions, as well as some here I'm seeing in the chat. So we'll do our best to get through all those. If for some reason we don't get to your question, we will have your advisor consultant for your region reach out to you with an answer. So I think you kind of covered the dollar strength, Jeff and Henrik, together. And maybe this one I think you may have touched on a little bit, maybe go a little bit deeper. So one advisor asked, I try to build portfolios with less volatility than their peers. How would this asset class potentially help me do that for my clients?
Yeah, I think we hit on that a little bit, right? You want the diversification that international investing offers. Hopefully it comes with not too much volatility and higher returns. And sort of based on those metrics, international small cap, I think, really stands above and beyond, the developed market worlds, the emerging market worlds. And so I think just from a beta to beta standpoint, which is what we're talking about when we show some of these historical index level returns, international small cap is kind of that first stop, right? When you're looking to diversify your portfolio and have an attractive risk return profile. And one thing I'll just add too, and it's the asset class that's also our strategy. It includes emerging markets, right? So it's not that you're not getting exposure to a lot of these attractive trends that we acknowledge in emerging markets. I mean, Henrik mentioned it earlier, India being an attractive place to be and invest in, and the portfolio is invested there today. So I think that, certainly, hopefully we've made the case that that's the place that you want to be in when you're looking for diversification and a more attractive sort of risk return profile in the international markets. And also, I think just on that, yeah, go ahead, Henrik. Sorry.
Yeah, if I can just add that the strong dollar has clearly hurt investing overseas in the recent past. But you also have to look at, are we now looking at a increasingly overvalued US dollar? And how much more can it strengthen before it starts to ultimately weaken? The other thing to keep in mind as you're constructing your portfolio is a very strong dollar is not necessarily good for US companies. A lot of the S&P has its earnings from outside the US. So if you have a very strong dollar, the competitive repositioning goes in the favor of companies overseas. So you have to look at that as well as you're putting the portfolio together, because this is not just a straight line relationship. If the dollar continues to move, then that's going to have consequences that could impact your portfolio.
Yeah, I think just on that point really quick too is, to the extent the trend in the dollar reverses and valuations outside the US are certainly more attractive than what they are inside the US right now. But those are just two maybe more easily identifiable ways in which non-US assets can really maybe sort of turn the tides a little bit more quickly here, just because those have been two things that have been sort of an anchor for the last couple of years here. One question, or actually a couple questions, and I'll kind of bring them all together, is just related to China and thoughts on investing in China. Now, you mentioned a little bit, maybe more environmentally right now, just with the way that they're handling COVID and maybe some of the regulatory crackdown as a risk. But I think, are there more structural concerns with investing in China in general that has you sort of shy away from that market as an international small cap investor?
Yeah, we don't have any direct investments in China. Of course, we have companies that do business with China, export to China and import from China. That's unavoidable. US companies has that too. Given probably the biggest thing for us is the corporate governance is a big issue, and regulatory changes. Seems like the government can come in and change the game overnight in certain sectors, and corporate governance tends to be poor. So given that scenario, we just have pretty much stayed away and have little or no exposure today, and we find better opportunities elsewhere with more upside and less risk. So that's what really drives the whole process. Where can we find really great companies that we have a high degree of confidence in that they can execute for the long term? And that includes some of these regulatory issues and governance.
And one other area that maybe a lot of the questions are asking about is more specifically around Europe. Right, Europe seems to be the economy is really in the crosshairs of the challenges in the world today, right? Certainly from an energy crisis perspective. So maybe just give a little bit of your thoughts on, the talk of recession, the talk of this energy crisis, and having as much exposure maybe to Europe as the portfolio has today.
Yeah, no, everything has been thrown at Europe these days, and but again, over time that will change. But that's where I feel very confident with our process and identifying companies that are very, very well run and well positioned within their chosen ecosystem, and staying away from the maybe weaker, more speculative companies. So in this environment, even though maybe the cake will shrink a little bit, they can take market share from their weaker competitors. And they also have the resources to deal with being able to restructure their supply chains and maybe their energy supplies, and will be able to basically adapt to a greater extent than the weaker companies. Also, quite a number of the companies we invest in Europe have global exposure. So they may be headquartered in Europe, but have very significant exposure to Asia and the US. So you can't just add up and say, okay, you have X% in Europe, and therefore that's all Europe. No, it's much more complicated than that. And so those companies will also benefit from the massive change in the currencies. So it's not all bad news by any stretch of the imagination.
Yeah, I think, we don't want to ignore certainly and sort of wave our hands at all these risks that exist today and talk of recession. I think really what you're speaking to is the ability and desire to sort of look beyond that and see the opportunities that are going to emerge as they ultimately do, as we've seen over time. So I think, there's a couple other questions here, and certainly we'd be happy to engage with you all on an individual level on some of these questions, specifically to kind of holdings in the portfolio, historical exposures. So we'll be in contact with each of you if your questions were not more specifically answered here today.
Okay. Yeah, I think that's about as much time as we have. So as Jeff mentioned, we'll get back to you. Your individual advisor consultant will reach out to you with answers to questions that did not get answered. There is a link to the territory map here if you want to be proactively reaching out to your respective rep for an answer. We'd love to hear from you, obviously. And then there is a survey in the chat. We'd love to hear what you thought of the webinar. So if you don't mind, you can click the link there. And please, provide us with some honest feedback on how we did today. But thank you so much for your time. Thanks for your attention. And thank you, Henrik and Jeff, for sharing your knowledge with us today.